Back. Is this the first one of the year? I'm seeing some yeses. Well, welcome everybody to the new year as well. My name is Hayam Mizrahi. I'm the CORFAC president for 2023. I come from MDL Group, which is in Las Vegas, Nevada. I've got a couple of announcements to share before I introduce the panelists, and we'll get right into today's program. First and foremost, the CORFAC Spring Conference is in Orlando, March 1st through the 4th. There's a fantastic lineup of speakers. The networking is going to be great. Our host firm, First Capital Property Group, awesome folks. They spared no expense. They're going over the top. I'm making promises for them that I hope they're okay with, but really looking forward to that conference. Early bird registration deadline is this Friday. So right after this, go to the CORFAC website, check out events, look at the lineup of speakers and get registered today. The next announcement is mid-March, we're going to have a retail panel similar to this office panel. So retail online best practices is the title. Again, a great opportunity for us to connect with each other, to network, but then also to get some best practices. I will add, while we're talking about retail, that ICSC is in Las Vegas. Jonathan, do you know the date off the top of your head?
The 22nd and the 23rd of May.
22nd through the 23rd of May. CORFAC does have a booth there. Several firms sponsor the booth, so you get a badge, logo placement, and a place to have meetings and drop your bag and charge your phone. So if that's something of interest to you, please reach out to Jonathan. All right, I kept the announcements brief. Let's get into introductions for today's panelists. The topic is office recovery, best practices. So the moderator is our CORFAC Transaction and Business Development Chair, the mad scientist himself, Mr. Ed Del Baccaro. Ed comes from TRI Commercial in San Francisco. Joining Ed and sharing what they're seeing in their markets and their best practices, Andy Simon with Hemsley Spear in New York City. Very interested to see what's happening there. The baddest broker on planet Earth. I know this because I get to work with her every single day. Tanya Gottesman with MDL Group here in Las Vegas. And John Adderholt with Century Realty in Pittsburgh. This panel is meant to be interactive. The panelists each have information to present, and there's going to be time for Q&A at the end. Without further ado, Ed,
take it away. Thank you, Hayam. So I've been introduced as mad before, but never as a scientist. So that's an upgrade. Thank you. By the way, people feel free to introduce yourself on the chat. Then if you ask questions. So this is going to be, we're going to have some 2 or 3 minute remarks from each of the panelists on their individual markets. They're going to address the status of the office market, both downtown and suburb. And what trends, how remote trends are affecting them, vacancy rates. Office is one of the weaker sectors across the country versus retail or industrial. So address that. Then we'll go into questions. I'll act as Ofra, a moderator. We'll ask questions of each panelist. And the panelists, I encourage, if they hear something from one panelist, just chip in and directly ask the other panelist. But for the audience, put your questions in chat and we'll try to answer them as much as we can. So why don't we start first with, let's start with Las Vegas. Tanya, we have what we call the Las Vegas Index. Several economists that I recently heard, I just remarked, said that as long as travel is going up and gambling is increasing, we're not going to have a recession. So Tanya, why don't you talk about your office market for a couple minutes?
Well, the office market here is, what you stated pretty much across the board as far as, it's the highest vacancy probably in all specialties or sectors. I think the interesting thing about Las Vegas is that we, as a whole, we only have 46 million square feet. And, you had stated suburban and downtown, but Vegas is pretty much all suburban. So everyone who comes to Vegas, what do you think of? The only place you go is the Strip. If you even talk about living here, I'm not living by the Strip. That was my first initial reaction 15 years ago. when we decided to move here. So, you know, I think the biggest story right now about Las Vegas is construction. And we have seen over 600,000 square feet of new construction, either that have come on the market or planned construction in the middle of construction that will be delivered in 2024. Most of this construction, if you're familiar with Vegas, runs along what's called the I-215 Beltway. So it's a beltway, a freeway that, you know, basically runs to two of the major master plan communities, Summerlin to the west and then Henderson to the east. So, you know, with that being said, we have a lot of lateral moves because employees, CEOs, they want to be in a centralized location for their employees. You know, we, even with the tax, the tax benefits here, we haven't seen in the office sector businesses coming from California. You know, you get more of that from the industrial. But the biggest story here is construction. Medical is still, you know, hot and heavy with all the hospital systems here. Vegas is trying to get more teaching hospitals. So the private equity groups are buying like the multi-tenant medicals. And then you have the owner user sales, which, you know, tell a great story with, you know, doctors, attorneys, they're wanting to purchase something because they know that they're going to practice for the next 10 years. The vacancy is pretty much remained the same since last quarter. So it's around 11.9%. And then, you know, I think the biggest thing with Vegas, everyone wants to know, is the hospitality. Hospitality is booming. You know, we have the Raiders, we have the Golden Knights, Vegas Aces, Formula One's coming in November. So with all that being said, I mean, we're funneling money through our city. Now, the biggest issue is recruitment and employment. And employers are trying to recruit employees, and they're, you know, want to go into office spaces that have these amenities, these walkability type buildings with fitness and restaurants and that sort of thing. So, but, you know, with the hospitality industry being so strong and education being the lowest in the states, there's an issue of recruitment. So landlords are building, or developers are building these buildings that have all of these amenities, and employers are signing these long-term leases to hopefully recruit employees.
One quick question, Tanya. What is the average Class A rental rate in your market?
We're about $295, so $35.
Wow.
So that's for the new construction. What used to be the average class, you know, rental rate, it's lower, but all the new construction is, you're going to see $35 to $40.
Is that net or gross?
That's on a gross basis.
Interesting. Andy, your turn. So we have to load up his screen.
No, I thought I'd give a quick summary based on your questions yesterday. We can let everybody introduce themselves, and I'm happy to do the slides I put together.
Very good. Go ahead.
Just a brief overview of New York. We're a little bit different market than Las Vegas. Depending on which firm is doing the tabulating, we're somewhere hovering around 500 million square feet of office space in Manhattan. I'm not even talking about the other boroughs. We have three main submarkets. We have the Midtown market, the Downtown Financial District, and the Midtown South market. The Midtown South market, for many years until COVID, was probably the tightest submarket in the entire country. We had a vacancy rate in the low single digits. And part of this is predicated on the fact that it's a much smaller market. And with the expansion of the tech companies, new types of businesses into our market, a lot of these are younger companies with employees who like to be in a cool neighborhood, funky space. And so these older buildings became very fashionable. They were in less developed business business type neighborhoods. These were more residential or recreational type areas. And a lot has changed since COVID. Part of that is driven by the fact that with the work from home trend and trying to limit the commute time of employees, there's been a push towards
Thank you very much.
relocating offices.
Yes, you could.
No.
Relocating offices closer to mass transit. And the downtown financial district would require from most commuters a second leg of transportation. The main transport hubs are in the Midtown Market, Grand Central Station, Penn Station, and Port Authority Bus Terminal. So trying to avoid that second leg with a subway ride on top of a train ride is something that employers have strived for. We have a very, very bifurcated market. New construction and trophy properties are absolutely seeing record pricing. The rest of the market is suffering tremendously. Our overall vacancy rate is probably somewhere around 19%, not vacancy, availability rate. So I'm lumping in sublet availability in that. We have a large percentage of the availability, which is represented by sublease space. Somewhere between 20 and 25% of the available space is probably sublet at any given time. Our average rent in Manhattan is probably around $75 to $80 a foot for the total market. But when I say that there's a bifurcated market, new construction and the trophy properties are getting well into the triple-digit rents. We hit a record rent on the top of a building adjacent to Grand Central Station that was built by SL Green. The top floors of that building set a record of 300 for the first portion of the term, going to 320. That's not retail, that's an office rent. It's amazing what's going on here. The bifurcation is just, if you walk around Manhattan now, you have projects that have been planned for a while that are moving ahead to build new space. Some of these are rather large and would require an anchor tenant to be able to properly move ahead and secure financing. Some are more boutique, and because the developers are well-heeled, they'll probably proceed without an anchor tenant or any pre-leasing. Remote work trends. Tuesday, Wednesday, Thursday are packed. The trains are full coming in from the suburbs. The subways are full. The streets are full. Getting a sandwich at lunch is crowded, partially because many retail establishments did not make it all the way through COVID, so there are fewer choices, and those that are open are very busy. Mondays and Fridays are dead. So that's impacting the local retailers, restaurants, etc. It's really a 3-day-a-week plus evening business, and really no lunch business or breakfast business on the Monday and Friday or weekends. Dinners, Midtown, packed. Reservations required. I'm referring to some of Ed's questions that he circulated yesterday.
But
productivity.
Andy, some of those questions I'm going to ask in general. So first, I just want a brief office market, which you just done.
Okay.
If that's okay.
Okay. Well, that's pretty much the overview in terms of the work from home, getting people back to work. There is a push, but there's a lot of resistance. Some of the companies have announced going back to work 4 days a week, not 5. There's been internal pushback with lists to sign, asking management to reconsider. And then you have companies like JP Morgan and Walt Disney who are building significant new headquarters, and their CEOs are not going to take work from home as an answer going forward. They're building these billion-dollar projects And they're not doing it to sit empty 2 or 3 days a week. I don't have much in the way of suburban, so that's pretty much it for the overall view from Manhattan.
Excellent. So now I want to go to John and talk about your a brief summary of your office market.
Hi, John Adderholt. We're talking about Pittsburgh, and I'll touch on our tri-state region, which includes Western PA, a little bit of Eastern Ohio, and state of West Virginia, at least some of it. And this might also be an indication of how a lot of these mid-size, small-size cities are doing throughout the Rust Belt and kind of middle America, if you will. I think Pittsburgh's fairly common with some of those markets. So we've got a vacancy rate of 11%, but the greater CBD is closer to 19%. And when you factor in the availability rate, it exceeds 20%. It's not great in downtown Pittsburgh, but starting to maybe recover. Our inventory is not huge in Pittsburgh itself, 40 million square feet. But if you lump in all the suburbs and some of the small cities right around Pittsburgh, that's 70 million more. So there's a lot of office space out there. Average rents are holding in the upper 20s for the nicer space, despite some of the negative pressures. 28 is the average in downtown, but there's a lot of lower rent deals getting done in the upper teens and lower 20s as well. The physical occupancy question is out there, obviously. Downtown Pittsburgh, I wouldn't say is dead, but it's hard to grab a lunch where you used to on a Monday or Tuesday or even Wednesday. A lot of places closed. A lot of places still have adjusted hours. Some of the staffing is still a problem. All that stuff hasn't completely gone away. But I would say some of the neighborhoods right outside of downtown are lively and doing great. And a lot of parts of downtown do come back to life. Not unlike what you heard from the New York report. I guess that is probably good enough for now. I'm trying to be brief.
Very good. So I'll give a brief view of the Bay Area, and then we'll do some questions to the panel. So we're a tale of several markets, and some of the trends reflect whatever it's already been said. So Marcus will correct me from our San Francisco office, but there's almost 27 million vacant feet in downtown San Francisco. So San Francisco is a tale of two cities. The downtown has a high vacancy, 25, maybe 30%. It's also a flight to quality market where the upper floors of the Class A buildings in downtown do well, lower floors not so much. Homelessness and property crime and business taxes is a big deal in San Francisco, and maybe they'll deal with it, but that's like a problem. Mass transit is way down coming into the city. So a lot of people are remote. Some of the suburbs like Walnut Creek benefit from that. Meanwhile, then if you go to South San Francisco, life science area, its vacancies are less than 3%. Average rental rates in San Francisco might be 66 full service, higher on the upper floors, flight to quality, lower in some of the floors. Ironically, the small tenant market is tight, but you're hearing about all the tech companies doing their layoffs. You move to San Jose, it's similar in one respect, in that there's 17 million vacant feet. There's a 17% vacancy. So, the middle of in the Mountain View area in the middle, you do have tech companies layoffs, but meanwhile you have Apple and Amazon buying stuff at the same time. By the way, for all the tech layoffs that you hear about in the Bay Area, and we are now going through tech layoffs, net employment in tech is higher today than it was a year and a half ago. So even though I had all these layoffs, in fact, one Google person who was laid off was complaining. He saw one ads for 10,000 tech people at Google. So what some of these companies are doing is right sizing and taking advantage to keep productive people, update their service lines. The East Bay, since I'm a New Yorker, sort of, we call that the New Jersey to downtown San Francisco market. There's several markets there. Downtown Oakland is mirroring San Francisco. There's large homelessness, anti-business attitude. They just raised their business payroll taxes, believe it or not. Vacancy rates are 25%. And people are not coming into the city as much. And meanwhile, the rest of the suburbs, and there's almost 70 million feet of office space in the East Bay, where I work, Walnut Creek. And so the Walnut Creek, it's around 20% vacant. We have 2 tiers of market. The upper class floor, we're actually at $60 a foot. So Tanya, we need $75 to build a new building. And so except for medical, there is no new construction in office buildings almost in the East Bay. The exception is life sciences. So if you go to Fremont, for instance, in South 880 corridor, the vacancy rate is 3%. And they're building new buildings for life sciences, biotech, medical instruments. They're converting buildings from office or tearing them down to build those kinds of buildings. Same thing's occurring in the Mid-Peninsula. They're tearing down shopping centers to build life science buildings, and they're converting buildings in Emeryville. So the life science, the medical sector is growing. What we call the fire tenants, the financial insurance, the back office, the Dilbert cubicle tenants are actually leaving the Bay Area because of house prices. I mean, the average home now in the Bay Area is $700,000. So that's a $200,000 income to break even. Think of that. Rents range anywhere from $2,000 to $3,000 for a 1-bedroom apartment in 2/3 of the Bay Area. So if you're only making, hear this, $120,000, it's hard to live here. So those tenants are migrating to Sacramento, Las Vegas, Texas, Colorado, Utah, and that. So since part of the game here is referrals, we should be exporting to the markets, in the 4 adjoining states, representing them, et cetera. Although I just read somewhere, I don't know if it was Utah or Colorado, said no more Californians. There's a prejudice against what California brings. So that's the general market. So now why don't we go around the panel? The first topic I want to talk about is remote. So the headline news is that most of the markets are back up to 50% occupancy of leased space. So we're celebrating that. So I want to go around the table. The only stat I want to give, if we settle down at 75% occupied in the next 2 years, in the East Bay alone, that puts 12 million feet of underutilized space on the market. So that's going to be a depressing thing, even if we get to 75% occupancy. So why don't we go around the table? Tanya, you first. What's the remote occupancy trend?
I mean, I think it's pretty much what you said. I mean, we're probably seeing a little over 50%, coming back to work. The rest are in a hybrid model. Now, hybrid, I think, at least here, it's not just working from home. It's, being able to work in a coffee shop or, all these things that all these young individuals are starting out who that's what they want. They're more concerned about, I think Gensler came out with a study, but they're more concerned about the way their environment is versus the money that comes in, which is completely opposite when all of us started. I mean, we were grinding. I mean, when I started in the business, you were there from before the senior guy was there, and then you stayed after, no matter if you had something to do or not, you're staring at your computer. So it's just a different mentality that, all these employers are starting to have with this hybrid model. Now, I don't know every key card that comes through on some of these office buildings, but I can tell you from the newer construction where they have these amenities and they have like these open areas in the common areas, they have open lifestyle type thing. They are bringing people back to work, and people are enjoying it. They like the new bright office with the floor to ceiling glass. Now, it's interesting because obviously Vegas is a huge gaming industry here, and we work with one of the major gaming companies in town, and they are struggling bringing people back to work. They initially January 1 required 2 days a week, and then the employees pushed back. Now, there's the argument that their current office space is one-story office near the airport, and it's dark and it's not bright, and it's probably not, there's no amenities nearby. So, but they are really struggling. But then you also have another gaming company that built 2 new office buildings in the Summerlin master plan area, and they too are struggling getting people back to work. So it's almost, I feel like the 10,000 square feet and below, or 15,000 square feet and below, they're easily getting people to come into the office. Anything above, where you're looking at, full buildings, 30,000 square feet and above, they're really struggling getting their employees to come back to work.
Very good. So one of your points, I just hired a young broker and he's on this call, Jorge, and he knows he has to be here early in the morning.
Yeah.
So some of that still continues.
Yeah.
Quality of job versus quality of life.
Right.
So Andy, you already touched on a couple of the Tuesday, Wednesday, Thursday syndrome. Monday, Friday's not working. Now is one of the sub questions would be, are tenants contracting because of remote? That's happening in our market, where they literally, because of remote, when they leases renew, they're actually decreasing 20% in some cases in our market. How about yours?
I couldn't hear that last part. They're increasing 20% what?
No, they're decreasing. So a tenant might be, like a law firm might be 40,000 feet in Oakland. And then when they renew, they're all of a sudden 25 because they're letting their staff remote, but the producers have to be in the office.
I was actually going to get into that when I get to my slides. In terms of the overall occupancy levels, we hit 52% through Castle Systems a report this week. So that's the highest reported recently. But I should also point out one thing that's not been reported at all, is what we were trending before COVID. We were never at 100%. Boston Properties has shared with me that they were tracking everything prior to COVID, and their typical occupancy levels pre-COVID were between 75 and 80%.
Oh, that's interesting.
So if you go by that measure, 52% today is pretty good. I heard that when we were struggling to hit 30%, and we were sort of saying, well, we're getting close to what was 50% of normal. So nobody's reporting that, but you're never at 100%. In New York, the people traveling all the time, or people, doing work at a client's, and so they're not in the office, whatever it might be. We have a lot of that historically.
So that's an interesting stat. We'll go to your slides after we just finish this question. Again, if you put that back in context, we're not doing so bad. Okay, so John.
Yeah, I agree with a couple of notes. I agree with Tanya on the culture change. I don't think companies are necessarily asking young people to come in and work 7 a.m. to 7 p.m. like maybe they were 20 years ago. That might be a whole host of reasons. I think law firms specifically are really downsizing. Kind of to Andrew's point, they were already working from home some prior to the pandemic. And I think that we've had multiple clients lose or just see law firms downsize substantially. Now, other industries are different. I think the real estate companies vary, but a lot of us are also more flexible with folks working from home. I think we're going to hit on this later, but the impact to the refinancing is just huge. And I'm seeing that firsthand, because you have these tenants that are making money and doing well. So they're not terminating their leases, they're meeting their lease obligations, but they have no intentions to renew with the spaces as they're currently configured and the size of them. Whether that happens in 9 years, because they probably not 9 years, 7 years because they signed a 10-year deal in 2019, or a couple years because they did a 5-year lease. But I think that's what we're kind of on pins and needles about, and the impact to all of the everything, CMBS, and just everything else that's going to happen when all the downsizing occurs, which I think is imminent.
So after Andy's presentation in a few seconds, we'll talk about financing. What's interesting in our market, and I think it's happening in other markets, is the stickiness of ask rates versus effective rents. So versus the 2010 Great Recession, we have less individual owners as opposed to REITs or institutional owners in our market. And so in a given market like Class A Oakland or Class A Walnut Creek, they'll stick to the ask rates of $60, but then you argue for free rent or tenant improvements, and the delta between effective rent and free rent could be as much as 15–20% in some of our markets. So that's an interesting dynamic to when we negotiate renewals. And landlords know that if the velocity of lease transactions in our suburban market at East Bay is almost down 70%. We're starting to hear the jokes again from 2010 is, what's a tour like? You have to wear a shirt and shoes if you do a tour. So some brokers haven't done a tour in 30 days on some of their listings. We're also getting now to the point of bonuses. So San Francisco, I know, is very high, but we'll add $1 a foot to $2 a foot for a 5-year lease just to on top of the commission if you bring a tenant in our market. So that's one of the trends. So why don't we now go to Andy, his slide, and then I'll answer some of the questions that were on the chat.
Great, thank you. And by the way, one thing that employers are doing when they do have their folks in the office is, especially in the winter months where it's dark earlier, is letting their employees have more flexible hours so they don't have to travel at night. I know a question was posed in the chat box about how safe is the city, how much crime, and that was a concern a year ago, maybe 18 months ago, even 6 months ago. Things are improving in New York. But there was that element, and there was some concern about having their employees, young employees, hopping on a subway at 6 o'clock at night when it's dark out, and concern for safety. So, as we look at the overall market and the impacts of everything that we've been discussing, you might say that in fact we're kind of in a perfect storm right now, and you're getting hit in two directions, from the leasing perspective and from the lending perspective. And so we've put a lot of thought into where's the opportunity in this type of a market, because I've been through a number of cycles now, and every cycle has opportunity. If it's a soft market or a strong market, there are different opportunities. You just have to figure out where that opportunity is. So in this market, the first thing I want to point out, and I touched on it before, the bifurcation of our market. The A product is not suffering. So the issues that are confronting owners right now are more geared towards what's happening in the Class B, Class C market in New York. And Jennifer, if you could switch to the next page. I've broken this into leasing and then lending. And again, I think John touched on this a little bit. First of all, you have the low occupancy levels due to the work from home trend. We have significant vacancy and availability rates. That's putting downward pressure on rents. And John, you were mentioning tenants reducing their footprints. The trend is definitely reducing the footprint. You don't need as much space. On the flip side of that, there has been a little bit of a correction in the other direction. For the 2 years leading into COVID, we seemed to finally be trending away from benching in an office. That's the type of layout where people are sitting really close to each other in a bench situation, not in cubes with dividers, but in a bench. And so the pandemic has probably accelerated the trend away from benching, which the impact will have a little bit towards increasing the amount of space a tenant will need, since they need to provide for enough space for their employees to feel comfortable. Another trend, shorter term leases for smaller and mid-sized tenants. This is purely based on the uncertainty in the market. Where are we going to be in a couple of years? Are we going to be in this work from home environment? Are we going to, need as much space? So that's creating shorter term leases. you can call it kick the can down the road a little bit to decide what we are when we grow up. Older B and C buildings need to upgrade periodically. That can be public areas, it could be building systems, elevators. And then the next piece, amenity space. Tanya was talking about that in her talk about Las Vegas. It's become a huge thing in New York as well. I guess it's true in all the markets. Buildings are spending significant money to create lounges, amenity spaces, or unusual things. The Seagram building, well-known 1950s building, one of the most recognizable buildings in New York, had a public garage, and they converted the garage, and it was 2 levels. There was some basement space as well. They've created a full-size basketball court, other gym features, a climbing wall, and a conference center lounge. So it's a huge, very successful type of environment. Key being to attract tenants who have younger employees, to give them something to come back to other than just an office. Another problem facing landlords of these buildings is the increase in construction costs. Tenant fit out. For the last 10 years, we've probably gone up 8 to 10% a year in the cost of construction in New York. So what used to cost $70, $75 a foot for a plain vanilla office installation now costs anywhere from $120 to $150 a foot. Couple that with the short-term trend for tenants, and you can see you have a problem. And of course, we were dealing for the last 3 years with tenant arrearages that owners were facing. And these would be factors no matter what market you were in, but we were in a low interest rate environment, and now interest rates are creeping up. So it's all, as I said earlier, perfect storm. Jennifer, if you could go to the next slide. I've now looked at from a lending perspective. I don't know if anybody saw, but CompStak and TREP came out with a report a week or 10 days ago. If anybody has not seen it, would like to see it, I think it's a very good summation of some of the issues facing owners today. There is a tremendous percentage of buildings with maturing debt over the next 2 years. Part of this can be attributed to the fact, similar to the way tenants were doing short-term extensions to kick the can down the road for major decisions. In that case, what we're finding is a larger percentage of expiring leases in the short term, because 2 and 3 year lease extensions a year or 2 ago leads to a larger percentage of lease expirations this year and next. Similar to building owners who might have successfully negotiated an extension of their loan, these will also be maturing. So you have a larger percentage of maturing debt. The report that I was referencing talks about the 11 largest office markets in the U.S. Apologies to our international partners, but the report is strictly U.S. based. The 11 largest markets have, over the next 2 years, $40 billion worth of maturing debt. That's about 6.5 billion in 23 alone. New York has 15, almost 16 billion of maturing debt in the next 2 years. Because of the uncertainty in the leasing market, you're naturally finding that lenders are becoming much more conservative in their underwriting criteria, or pulling out altogether in terms of offering refinancing or new financing for acquisitions or new clients. You know, if it's an old New York family that has a banking relationship with JP Morgan and their portfolio is strong, their basis is low, they'll get the refinance. That's not a problem. But the inexperienced, less seasoned owner is finding less in the way of financing options. The cost of the money is up. We all know the Fed has raised the rate several times in the last year. So if you are now facing maturing debt, you're looking at rates that are double or more than what you had seen previously. Therefore, the downward pressure is going to be significant on top of the increased cost of construction, on top of the shorter term leases that tenants are doing. It's, again, the perfect storm. So banks have begun to increase their reserves in anticipation of problems. So what does this do? What's the opportunity? Jennifer, the next page, I'll try to sum this up quickly and let other people weigh in. Back in the late 80s, early 90s with the S&L crisis, there were a lot of buildings that were handed back to their lenders, and lenders were set up with internal asset management departments to be able to handle this, transition the properties into a better market so that they could deal with the asset at that point by sale or whatever, refinance, whatever it might be. The banks haven't done that as far as we know today. Most of the banks are not set up to take these properties back and manage them, run them for the foreseeable future. So next slide, Jen. The three choices that are faced are continue the extend and pretend, a short-term extension of the existing debt, hoping that within 2 or 3 years, there's a better environment to be able to do something on a more permanent basis. Working with for the lender, working with the owner to restructure the capital stack. If they were highly levered and now their interest rates are way up and the lending practice is more conservative, you're not going to replace that capital on a dollar for dollar basis. So the owner's going to have to come up with more equity. So how do you do that? The lenders will have to allow partial interest sales or mezzanine debt to be placed above the senior debt. You're going to see a lot of movement in this world. And the last piece is the sale of the asset, which is the old, typical solution. The problem is with interest rates rising and all these problems, the sales market, the valuations haven't settled yet. Cap rates haven't settled. So that's really not a viable solution until the dust settles. And those are the areas that we're finding and we're anticipating a lot of action from a brokerage perspective over the next couple of years. And we're gearing up the office to be able to talk the talk and approach the lenders or the owners and work in that space. And I'm sorry if I took longer than allocated.
First of all, that was fantastic, Andy. And I like that phrase, extend and pretend. I'm going to use that. I'm going to make one comment to or answer one of the questions, and then I'm going to ask each of the panelists. The interesting trend is if you have this kind of vacancy, if you have lowering effective rental rates, how does that affect? Are we going to have some foreclosures, restructuring of loans, etc.? So the comment to one of the questions was, is there crime increase in cities across the board? So I can't address the Midwest or the Central, but I know on the West Coast, whether you go to Seattle, Portland, Oakland, San Francisco, LA, property crimes and homelessness is way up. They correlate with each other. There's, how should I say, progressive mayors in charge of those cities. And so that's one of the factors in the downtowns emptying out. Where there's good news is, in fact, Andy, you would like this, I read somewhere in New York Times, there was a study done on cities and specifically in New York from 1848. 1848 was a bad year for New York City. They find that every 20 to 35 years, cities ebb and flow. So at the end of the day, you have downtowns in crisis, you have restructuring, but then symphonies come back, art comes back, restaurants come back, and a new employment dynamic. So we're probably quite a few years away. We're in the down cycle in the West Coast cities, that's for sure, in terms of crime and property crime. That's having an effect. So in the few minutes we have left, let's talk about what's going to happen. So Andy raised some key points there. So I'm going to start with you, John. is Pittsburgh and the greater metro seeing, do you see foreclosures coming? Do you see the financing issues for CMBS being restructured? John first.
Yes, and there was a large building in downtown that just won a couple of big new leases, and then it was reported and went to servicing a couple weeks later. We all were scratching our heads thinking, gee, if they're going to servicing, who isn't? Another thing I just wanted to hit on, which is related, there are a lot of conversions from office to residential are being considered or happening in Pittsburgh. That was already underway pre-pandemic. We talked to one of the larger contractors the other day in Pittsburgh, and they were pricing 15 of these projects, several of which were substantial in nature, over $20 million, over 100 units kind of thing. So I think the big question is how many more of those can work. So I think that's, yes, we're going to see buildings transition. We're going to see foreclosures, and that's when some opportunities can arise. The second or third buyer in is often the one that can make the numbers work, and but maybe it's a new use.
Very good. And in our market, you had a sub-trend there in terms of conversion. We're not seeing Class A's really converted. Class A's might be converted to medical or some tech uses, but it's the obsolescent B and C buildings that are even being converted to residential, torn down. Part of it is the size of the floor plate, window line ratio. But 50-year-old wood structure is a conversion opportunity or something else. Tanya, what about your market? Are you going to see foreclosures or restructuring?
Definitely, I think some of restructuring. I mean, there's a project that is 10 Class A office buildings in a less desirable location. You talk about homeless. There's a lot of homeless there, drugs, that sort of thing. But there's talks of this particular portfolio that, may go to servicing. Right now, it's interesting. They have a lot of tenants that are coming up for renewal, and the landlord isn't really willing to work with the brokers in the market and renew these tenants. So I think the writing is on the wall there. But, again, we do a lot of owner users here because our size of our tenant, it sounds like across the board, but our typical size is 2,500 to 5,000 square feet. So what is interesting is these owner users, even with the interest rates higher and SBA rates higher, they're still wanting to go into a building, spend the money for whatever the price of the building is, which is anywhere between, close to $300 in a desirable market, and then still willing to put $150 in TIs. One thing that's interesting is that our team, we work with a developer who builds gray shell construction, and we've partnered in a sense with a local bank here in town and offered a buy down program. Now, we see buy down programs in residential. I have never seen it in commercial. So it's a 3-year buy down. Obviously, you have to qualify with the bank. And it's 1%, 1.5%, 1%, and then 0.5, and then you can refi, and it goes back to the rate, whatever is at market. And the developer is paying that buy down fee, which equals to about $25,000. So we're trying to be creative in different ways on helping individual owners with the financing. Now, on the flip side, the owner can go to their bank and say, hey, can you match this? Which I'm assuming probably will happen, but it's a good carrot to dangle in front of these buyers who are looking to purchase owner user and want to do their own TIs.
Very good. So you mentioned something that we haven't really talked about, interest rates. They are high. They're going to get higher. So if your pro forma was based on 2.5% interest rates and now it's going to be 7.5%, 8%, it's a different world. So to the extent I can see, if you raise your hand or chat, let's take a couple direct questions from the audience in the last few minutes. Is there anybody that wants to ask a question? Not a speech, but a question of the panelist? Or if I can't see you raise your hand, somebody talk. Wow. Either we were boring or we answered all the questions. So, but I am going to call on Marcus in my San Francisco office. And Marcus is actually, again, part of this, the reason for this panel is how do we make money? And I want to say we're over COVID, despite COVID. How do we make money because of high interest rates? How do we make money because of restructuring? A lot of our own institutional owners are in several markets, so they might be having an issue in San Francisco. Does that give an opportunity in Pittsburgh or Orlando to right size a portfolio? So Marcus, why don't you talk about what you've been tracking in CMBS loans in San Francisco?
Yeah, I mean, San Francisco, there's a city of two tales, really. We see property values plunging in some Class A areas down to $300, $350 a square foot from the highs of $800 to $1,100 range. And then every now and then we see a building sell for $1,100 a square foot, and everybody's scratching their heads going, who was involved? Who are the brokers? That's usually the first question. Who was pushing the sale and what was the motivation of the buyer in that case? We certainly know the motivation of the seller. We are definitely going to see some defaults in this area. I recently attended a panel that talked about residential conversions, and it's really in San Francisco itself over the last 30 years. I think I've seen 8 buildings convert from commercial to residential. It's an extremely pricey proposition. Unfortunately, our city struggles also with a lot of overlay on the bureaucratic side and politics. As Ed mentioned, we've seen the same traffic on toll bridges as we have seen pre-pandemic, but public transportation is down to about 30% of pre-pandemic levels. The same complaints from employees saying, I don't want to come to the city. There's homelessness, there's crime. I'm scared of being back in the city. And then we don't see the same kind of reaction from City Hall, which is policy related. So there's the two struggles. There's the real estate market, and then there's the policies coming out of the city. Defaults will occur. Yeah, defaults will occur. What I caution brokers to say also, there's opportunity, because the opportunity exists with the anchor tenants. If you are a 30% plus tenant in a building that has a refi coming up in 2 years, within 2 years, you have incredible leverage, because the landlord knows the minute you walk, he's probably going to lose the building. And so he can structure leases based around financing and leverage the tenant's position in that regards. So there's opportunity.
Very good. So there is a question in the chat where most of us were talking, some of us, me specifically, talked about a 20% reduction in footprint. So the question, if anybody else wants to answer, is that a permanent? I mean, how long does that last? I think that's going to be a factor for the next 3 years, more to the professional tenants, so CPAs, accountants. Automation is and offshoring is having an effect. By the way, if you're too remote, you could be offshored. So if you call United Airlines or a bank, you're now getting Philippines, Mexico, Indonesia to answer the phone. Those people used to occupy square footage. So if you can be remote and you're in customer care, you might be offshored. So that becomes a net reduction. The second factor is AI. AI is automating certain office functions, and that, the labor shortage. So that's going to be a net reduction. And just so I could see some of the back office not coming back. Anyone else have a comment on that, maybe?
Well, there's been a trend in many of the businesses, for instance, law firms. Over the years, the need for a law library went away because everything is digital now. Partner offices don't have to be 400 feet. So the trend has been down. I don't think you can make a general statement overall from all industries about the size of the reduction. But I agree with Ed. I think over the next 2 or 3 years, you'll continue to see this trend to a certain extent. And some of them are using this opportunity to take less space, but move up in quality to the more expensive buildings. So their annual dollars spent on rent may be similar to what they're used to, but they're occupying less space in a more efficient building.
The top 20 buildings in San Francisco have seen an 11% rent increase in the last 2 years.
Which is again,
so that's your flight to quality. That's your flight to quality. Yeah.
I couldn't tell you the number in New York, but when you start to see $250 and $300 a foot, it's way up there.
You better have a productive employee that's paying $200 a foot.
Yeah,
make money. So do we have
the group that paid the 300, 320? It's the Amex Black Card membership club. So it's on the top of the building. So their members with the black card can go in there and hang out anytime they want and use their space. It's really a lounge for high rollers.
Well, that's not me. So Jonathan, do we have a hard stop at 9 o'clock?
I mean, as long as people want to hang on a few extra minutes, that's fine by me.
Okay, so we're approaching 9, 2 minutes to 9. Does anybody else have a question that they would like to ask the panelists? So again, this is a preview run up to Orlando. We're going to have some sessions there. And, you know, we have in some cases, common tenants, common clients. So let's run into each other, refer deals when we go to Orlando. And the business plan, I have several people from TRI on this call, and our specific business plan sessions that we're having here is 10% of our broker income should come from a CORFAC referral, whether it's an export or an import. So, so we're going out of our way to see how we can help either export tenants to Arizona. So Phil might send you some tenants, or how do we import from Boston, you know, more biotech, that kind of a thing. Any other closing questions?
Yeah, this is not a question, but in terms of getting together in Orlando, one thing I broached a few weeks ago, Ed, it may be outside of everybody's comfort zone, but a lot of the major markets have the same lenders in some of the major buildings. Think about any relationships you might have with lenders or you might be able to develop with lenders. And maybe we talk about it in Orlando. Maybe there's a way to approach a MetLife, who we know a little bit in New York, but maybe they have a problem asset in San Francisco or Miami. And maybe there's a way to work together to try to assist.
Excellent. You know, so I call that the sixth question. I'll get to you a second, Ray. The sixth question where Ray said goodbye is that besides your home market, ask the outside. So first, I want to ask Doug from the Philippines has a question comment.
Hello, everybody. Yeah, Doug here, originally from Arizona. So Ed, shout out. So I've been here in the Philippines now for some time. I'm actually in our industrial sector, representing TFA Commercial Realty. Our office guy, Vince, was unable to join tonight. But an interesting thing that I've observed here versus the United States is that the Filipino culture wants to be in the office. They want to be participating with the team. They like the bond, and so we're not seeing as much of a drive behind, at least from what I see, behind the conditions versus rates versus payment earnings. So it's kind of an interesting thing. Certainly, if anybody has clients that are struggling in those aspects with office space locally, domestically, and looking to offshore them, while it's always a blow, we are here and are open. You know, we'd love to be able to network and make new contacts and look forward to working together to satisfy all of our clients.
Well said. You know, again, brokers represent change, not just their city. So the market's going up. How do we represent growth? If it's contracting, how do we represent growth or restructure? So if part of it is to move data centers and other office functions to offshore, we should be working with Doug. Any other comments or questions in the last minute or so? Trent made a comment at special servicers. So in addition to the banks and the lending offices, make friends with special servicers. They need opinions of value. They need market knowledge, and they could be a lead as to a structure of a building. The other thing that occurs in some of the B assets, maybe some of the A, is that generational change. So the patriarch or the matriarch ran the portfolio for 15 years. They pass away. Now you have the second generation in 4 states, and they don't want to put up with restructuring, so they sell, even at a reduced price. So again, look for generational change in some of these ownerships. Any other comments? questions? Jonathan, back to you.
No, just thank you, everybody. Great conversation as always. This session is being recorded, so if you want to, we will shoot that out to all CORFAC members in the next day or two. So feel free to push that to folks in your office and let them know the good stuff that we're up to.
Very good. Well, everybody have a good day and see you in Orlando.
Thanks all.
Thank you.
Ed, Jonathan, thank you.